I think we're just a little bit later in that cycle, closer to the probably seventh or eighth inning overall, which is why we're starting to see IPOs, why we're seeing all this excitement. And I think you just want to be aware of that, govern yourself, govern the portfolio accordingly. But it doesn't mean that this is over yet. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, here we go. It's Friday. We're back. Another podcast, another weekly video update. How you doing over there, Greg? What's going on? What's happening today?
Yeah, no, everything's good. I was saying earlier, this is what I find kind of the best time of year. The days are long, the sun's out. Markets in general have been pretty resilient, pretty robust. I mean, we're off a little bit today, but in general, they've been moving. And then, Will, last night we had the Wealth Professionals Awards. So we had a good team event last night, which is always fun.
Yeah, it was cool. We had the Aretec team out for the Wealth Professional Awards, which was awesome. It's good fun, good team building event. Nice industry event, which is awesome. We had a little video that they came and did on us, which was kind of fun. Just a fun video. So it was good, but nice to do that every once in a while. I think that's 2 years that we've been to that event, and nice to get out every once in a while.
Yeah, nice for team bonding experience, but also talk with other professionals in the space and collaborate and bounce ideas off one another. So it was a good event. I think we'll be doing that for years to come here.
Oh yeah. So, anyways, looking forward to getting into markets, everything that's going on. It's been a pretty good run here that we've had in the markets. I know. Today, at least as we're filming this on Friday morning, markets are off a little bit. We had jobs numbers come out in Canada and the U.S., which were stronger than expected. It's one of those stories where we've got good news is bad news. You've got strong jobs numbers, economies growing, unemployment's going down. All of a sudden, maybe that means that interest rates aren't going to go down, and there's inflation concerns that the economy's running a little bit too hot. So markets are off maybe about 1% or so. The more growth-sensitive names like the NASDAQ-type technology names are off more because they tend to be quite a bit more sensitive to the interest rate and inflation story and that end of it. But nonetheless, it's still been a pretty good week, pretty good run. Another strong week overall where we're seeing everything. Our strategy, portfolios, markets, right up against the all-time highs. So pretty nice to see overall.
Yeah, Will, maybe you could give us some context as to, because I'm talking with a lot of clients this past week, this past month, these last few months, and they're just surprised about how well the market has done. It continues to hit all-time highs. It seems to be very resilient, very robust. So maybe just from your perspective, why are we kind of seeing that given everything going on?
Yeah, I mean, I think a big underlying driver of that is the technology trade and the AI story, and that continues to be a major leader in the market. And I also think that's probably where a lot of the risk is concentrated. I mean, not entirely, but it's certainly the spot that's been running the hottest, especially over the last 2-3 months since the war and the sell-off in March. So that's an area. I think what you're starting to see the market story develop into is one of inflation and interest rates, and is the economy actually running too hot? Are interest rates going to go up? Is this going to be a 2022 type of situation all over again? And I think that's some of the risk that you're starting to see in the market. So we've tried to focus a little bit more. I mean, certainly not entirely. I think you want to be careful about how much you've got in those growth type names, those names that are going to be very sensitive to the interest rate environment, because I think that's where a lot of the risk is carried. I mean, not entirely in markets. If things were to go and turn and go the wrong way. It's certainly going to pull everything into that mix and complex. But if you go back and look at 2022 is probably the most recent example is technology, NASDAQ, all those areas went through a pretty significant sell-off, and it was on the back of post-COVID inflation concerns, interest rates going from near zero, all going essentially sky high, inflation up near double digits. So that's some of the risk that's out there in this market, not to that extreme, but remember the last couple of years we've had tariffs, now we've got war, we've got high oil prices, all those things could lead to an inflationary environment. And I think that's where some of the risk in this market lies.
So are we starting to see, Will, the market kind of look past everything that's going on in the Middle East and the war and just kind of maybe more look towards, okay, how's the actual economy doing? Are there inflation risks? Are there risks that interest rates are going to be higher for longer? Is that kind of where the narrative is shifting to?
I mean, certainly less off the Trump story and war in the Middle East. I mean, going back to March, April, all through first quarter, early part of April, you couldn't get away from it. I mean, I think now that's as we move towards the end of the year, that's a situation that they want to be out of, unwind somehow. Probably not so easy to do as we've seen, but the market just seems not to be responding to every little bit of news on that in the same way. I think one of the things when it comes to energy and oil from that whole situation is we're likely, with all the disruption as well as oil has done, I think with all the disruption, you're going to see oil prices stay elevated or have some pressure on them for some time. I don't think we're going back to 2025 oil price levels at this point. One is that there's still disruptions, of course, to the supply chain. They take a long time to work through the system, everything that's happened there. And I think the other thing you're starting to see happen, similar with other resources, other commodities, countries are actually starting to stockpile oil and build up reserves and say, you know what, we can't be completely dependent on what we're seeing because of the geopolitical uncertainty. So that sort of fits that longer term commodities super cycle bull market theme that we've got. Again, this stockpiling of resources, stockpiling now of energy and oil. So we actually made some trades this week in the portfolio with fit a little bit with that theme. So maybe we could talk to that a little bit.
Yeah, so we were making a few moves, and the idea behind that, Will, is you talked about how kind of the growth areas of the market are looking a little frothy, a little overextended. AI has kind of taken them to these record high levels, but we've made some moves, and we're kind of looking at maybe more of the value side of the market as opposed to adding more money into the tech space.
Yeah, I think that looks a little better, and there's just it's the one area where positions are not running extremely hot. They're not completely overextended. They're not at insane valuations. I mean, look, we've got our fair share of technology. I mean, we've had chips, semiconductors. We've had stocks, which I think is up in the 200% now range since we bought it a couple of years ago, which is wild. But that trade, that position can't go on forever, and this is a theme we've talked about the last little while. But I think 2022 is a much more recent example where tech is going to go through its ebbs and flows, and it's running really hot right now. But the area that tends to pick up when technology starts to slow down, and let's say we've got inflation, we've got higher interest rates, we've got pressure, is you go to that value pocket of the market. You go to dividend names, more hard assets, more real businesses, real cash flow. That's what outperformed in 2022. If you pull that back, look at a bigger picture through the late 90s and 2000s, yes, technology did incredibly well through the late 90s, but if you were invested in heavy correlation with the NASDAQ, S&P 500 from 2000 to say 2009, it didn't look so great for your portfolio if you were more invested in traditional businesses, real businesses, value, cash flow, hard assets, natural resources. Looked a lot better. A simple way of thinking of it is you probably want to have a little bit more correlation in that environment with the TSX. The other place as well, international markets. International markets since 08, 09 really haven't done a whole lot. But if you go back further, that's an area that period outperformed. So more international global markets. We've been consistently adding to certainly a lot more value there. Not the same growth in technology and AI excitement, but really just trying to balance out the strategy and have the right mix and positioning for clients.
Well, what we saw, Will, in 2022 is obviously all the markets were down, but the TSX on a relative basis held up much, much better than the tech heavy NASDAQ. To your point, that's going to be more sensitive to interest rates. So, not saying we're in that sort of environment, but I think the idea is to kind of shift towards more that value area of the market as opposed to adding more money into tech at this point.
Yeah, and I mean, one of the signs that maybe tech is getting a little bit frothy here is this SpaceX IPO, which we've been getting questions about, which obviously all over the news. It's um, tough to not hear about that. But what's going on there? What's happening with SpaceX, Greg?
So SpaceX, there's been a lot of talk about it. It's been the talk of the town all year. So it's IPOing next Friday. So maybe next Friday we'll have a, kind of an update on what's going on there. But I guess the interesting thing, Will, and kind of to your point, that's going to potentially carry some risk is that right now the valuation for SpaceX is looking north of 1 trillion, almost at true $2 trillion, which is going to make it one of the most valued companies in the world at this point.
Yeah, and that's a little bit crazy, and it's not that it's not a good story, and it's not incredibly innovative, and there's a lot of growth, and they're on the frontier of all this exciting stuff. But it's a private company. They're going out to markets, and their goal is to get absolute peak valuation for the shares. They're selling shares. They're raising money for the company for future growth. And if you look at statistics historically, IPOs, when you buy them initially, yes, there's a lot of excitement, there's a lot of emotion, there's all kinds of hype. Often they take off early and make a quick move up and go even higher, and everyone is excited. But the statistics historically, I think on average, most of these are down and down significantly even after the first year. And the reason is that the investment bankers, the company themselves, exactly that. They're trying to get peak valuation. They're trying to get peak price point. They're not going to sell their shares out to the market at a discount. So they're going to do it when retail investors are excited about the markets, excited about the space. And so it's not that it's not a good company and a good story and good growth potential. I think it's probably one that would make sense to be a little bit more patient on, let it settle in. It's going to sounds like it's going to get some index inclusion because it's so big. It's going to be one of the biggest publicly traded companies in terms of market cap in the world. So it's going to make its way into the NASDAQ and some other indices, I think, pretty quickly. So most investors will have some indirect exposure anyways pretty soon.
Yeah, so we have SpaceX, which is coming out next week. So anywhere between $1 to $2 trillion market cap. But then later this year, there's also Anthropic, there's also OpenAI. And when you look at the projected market caps at this point, again, it's right in that $1 trillion range. So, three IPOs that initially are going to be some of the most valuable companies in the world. Obviously you want to just kind of be mindful of that.
Yeah, and look, you had cycles like this coming out of COVID. Like, think of the technology boom that happened out of COVID 2021, and then look at what happened in 2022 when you get that growth scare that happens in markets. So I think, and it's impossible to say when exactly we're in that time, but I think that's what it's starting to look like, that it's getting closer and closer to that, which is why, again, I think maybe a little bit more value investments, a little bit more discipline. Not that you can't have the technology, can't have the growth names, some of the AI and semiconductors and technology names. It's just once you start to see the IPOs coming out, I don't think that's not at the beginning of the cycle. That's going to be closer to the end of it. So just be careful. And I know that some clients have uh, reached out. I mean, for us as fiduciaries, discretionary portfolio managers, we're not getting directly involved in IPOs, but I know banks and that out there are. I would just be cautious about that. You want to size a position appropriately if you are getting to that sleep at night level for sure. Because I think probably SpaceX is going to be a bit of a rodeo.
That's probably that's a good way to put it. And just to your point, Will, about cycles. So we're kind of at the cycle where IPOs are starting to come out. These are not value oriented companies. These are high growth companies. And then we were just talking about what we're seeing with interest rates. We're likely seeing a higher for longer rate environment that's going to put added pressure on these types of names. So there's a couple different factors that are at play here.
Yeah, there's tailwind. So I mean, I don't look the history doesn't repeat itself. It tends to rhyme. I think that's a Mark Twain quote or something like that. I don't know who it's attributed to, but history tends to rhyme, and so I think this is rhyming a little bit with 2020, 21, 22 type of environment, and then historically it reminds again of the late 90s, early 2000s. So that's part of the reason too. We've tried to position more towards commodities, more towards value, hard assets, infrastructure, all those things. But again, it's complex. Remember too that the technology story, the AI story is also feeding into the commodities and the hard assets in a lot of cases. And again, I don't think it's over yet. It doesn't mean that tomorrow or next week that all this is coming to an end. It's just being aware of where we're at in the positioning. It's still very much a bull market. We're seeing that in terms of performance, bottom line result, and oftentimes you can actually see the best returns, best upside later on in this cycle, and it can go on a lot longer than you think. And so that's one of the reasons that we manage the portfolio, manage the strategy the way that we do, because we don't necessarily want to be sitting out of the markets all through this, waiting for some event that could take years to happen.
Yeah, and with our process, well, we're not looking to make short-term trades based on headlines or based on what's coming out in the news. Tomorrow it's more about positioning the portfolio more longer term to make sure we're in those right pockets and areas.
Yeah, positioning and strategic positioning, tactical shifts to manage that risk and take advantage of opportunities. But at the end of the day, as always, we want you to be wealthy. We're seeing that in portfolios this week and overall and this year moving in the right direction. We want you to feel wealthy. We want you enjoying life, enjoying retirement, having a good time, enjoying your money. We want you to realize your wealth. That's what we're all about. That's what Aretec Wealth is all about. So we'll be back with everybody next week. Enjoy the warm and sunny weather, and we'll talk with you soon.
See you soon.